talk about the economics in lieu of the election outcome. Jahangir Aziz, head of Emerging Asia Economics at JP Morgan, joins us on the show right now. Jahangir, hi, morning. With the election result this week, how important is a stable government at the center for the economy?
Sure. I mean, political stability is obviously key to macroeconomic stability and growth. And I think everybody is looking forward to that. Having said that, I think if you go back and look at Indian history, elections, and the results of those, and compare it to the economic performance that followed those administrations, while economic stability, political stability is important, it is not really the driver of economic policy changes or the driver of good policies. Oftentimes, stable governments become too complacent and you end up with outcomes that are not necessarily what you expected at the beginning. So I would say it's important, but it's not critical. Turning to your question about, what we expect this new government to do, I think clearly bringing back growth is the foremost in everybody's mind. And I think that's where there are binding constraints in India. And the binding constraints in India are twofold. One, there is this physical implementation constraints, land acquisition, etc., which unfortunately are in the hands of the local governments and the state governments, not in the hands of the central government. So the central government will need to get the states to start addressing those issues. And separately, there's a financial constraint that has creeped up, especially in over-leveraged infrastructure-related firms. And that's where the public sector banks and how you deal with this over-leveraging becomes important. I think if they address these two questions, I think you could start a meaningful investment cycle in the coming months, and that should be able to propel growth significantly.
So, Jahangir, what is your take on India's potential GDP growth, and what will be the drivers for India's GDP growth over FY15 and FY16? And what are the key upside and downside risks to your mind?
I think one thing that we have not noticed in this serious decline that is taking place in growth from 9% back in 2010-11 or even 10% back in 2010-11 to the 4-5% at this present is that our potential growth, i.e. the amount of capacity that we are adding to growth, that itself has fallen. So if you measure the gap between what potential growth is or what is trend growth, what is the capacity of this economy to produce and what is being produced, that gap is not very small. In fact, that is one of the reasons why you notice that core inflation, despite whatever has happened to the headline inflation, which went up to 10%, came down to 6%, is back up again. Core inflation has remained virtually unchanged at 8%, which goes to show that there is, despite the decline in growth, on the headline growth, there is very little excess capacity in India. And that stems from the fact that India hasn't really done any corporate investment since mid of 2008. And that's almost 5 years now. And if you do not have that longer period of corporate investment in equipment, in new technologies that will propel productivity growth, you will have a situation like this where you have low growth and you have at the same time high core inflation. So clearly the trick is to get corporates to start investing in equipment and start investing in new technologies that will bring back productivity growth back into India. Now, whether that happens or not, again, depends on whether the government is able to remove the binding constraints in India.
Do you think the perception for India could really change if we get a stable government? Do you think the US QE taper, or do you think the US QE taper and possibly rise in interest rate may still pose a big threat for foreign flows?
I mean, both are clearly important questions, but if you look at the flows that have come to India, let's say starting from December last year to currently, there are two sets of flows that have come in. One is equity flows and the other is debt flows. Now, if you notice that the debt flows that have come into India, which have been significantly larger, by the way, than equity flows, the debt flows have come in basically to reward the existing government for the macroeconomic stability that they brought to India since the massive disruption that took took place when QE rumors started back in May last year. And there the credit goes to the existing government for actually bringing together a decline in the fiscal deficit by keeping current account deficit under check, and to the Reserve Bank of India for having a very, very strong, prudent monetary policy regime. Equity investors, on the other hand, have been bringing in money with the hopes that growth is going to be propelled once a new stable government is back into power this month. And I think, therefore, the two drivers of these two flows are very different. And the important thing for the new government to do is to keep balancing the two of them. They cannot give up macroeconomic stability, in which case you will see debt outflows taking place, and it has to start living up to the promises that the equity market has derived over the last few months, that growth is going to move up. Turning to the question on what global economy, impact of the global interest rate, clearly that's a very, very big thing for India. We saw that in May last year, that even the rumor of a QE had completely disrupted the Indian economy. But the important point is, and this is where again credit goes to the RBI and to the existing government, that they managed to demonstrate that they can take pain. Therefore, if you look at January, when again there was a sell-off in EM assets, you did not see the impact falling on India and Indonesia, if I may add. Consequently, the fragile five that we keep talking about, I think India has demonstrated that is no longer part of the fragile five. Now, of course, that depends on whether or not macroeconomic stability is kept intact. But I would say that the impact of a rising interest rate obviously is going to be hard on India. Rising US interest obviously is going to be hard on India. But it's not going to be as disruptive as long as they keep demonstrating that they can take pain and take the necessary steps to make sure that the macroeconomy is kept in proper order.
Jahangir, how grave is the risk of a subnormal monsoon though? I mean, what do you think is the impact that it could have on food inflation and also thereby on the GDP data?
I think, that's always a big, difficult question to answer, and we haven't really been able to predict weather patterns very well. But by all indications, this is an El Nino year. How bad the El Nino effect is going to be, of course, it depends upon, how intense it is, A, and B, the geographical distribution of its impact, and more importantly, does the El Nino effect have greater impact on places in India that already have irrigation or places in India that don't have irrigation? If it affects states that have irrigation, then I think the impact is going to be much less. I, for one, think that if you look at the drought situations over the last few years, India does not really have the droughts do not really have that big of an impact on real GDP. At the end of the day, agriculture is only about 14-15% of GDP. So yes, it does have an impact, but it's not that big. The much bigger impact is on inflation. And the reason why it affects inflation that badly is because it changes people's expectations. The moment you hear of bad weather, the moment you hear of agricultural supplies going down, you start getting food inflation-driven inflation expectations skyrocketing. And that is the really big problem. That once you have expectations going up, it again feeds into core inflation, headline inflation. So I would say that much more disconcerting is the impact it might have on inflation rather than growth.
Jahangir, I want to get you in on the currency because that also seems to be a factor which is aiding the equity move somewhat. We've seen the best gain since March 6th and we've reached the 60 mark. What, according to you, is the fair value for the currency, and on what level do you think the RBI may be comfortable on the currency in order to retain export competitiveness?
I think that it takes a brave man to come to say something about the fair value of the rupee. But based on, what we have done on our own side, both in terms of, the economic fundamentals that drive, over a 1-2 year period, so it's not about, what's going to happen in the next month or so, but over a 1-2 year period, I think, the fair value of the rupee typically is driven by the growth differential India has with its trading partners and the inflation differential India has with the trading partners. Growth differential tends to appreciate the rupee and inflation differential tends to depreciate the rupee. Now, if you look at the growth differential of India, given the fact it has fallen from 9% to 4%, has narrowed. Therefore, that push towards appreciating currency has gone away. And inflation differential, on the other hand, has gone up. Even though India's inflation may have come down, its trading partners' inflation has fallen even faster, largely because there is a global disinflationary trend at this point in time. So consequently, we do think that going forward, the disinflation, the depreciation pressures, again, from a 1 to 2 year perspective, will be stronger than the appreciating pressures. We think that perhaps around 59.60, given the current current growth in inflation differential, 59.60 seems to be a reasonable assumption that that's where the fair value of the rupee is.